The hidden thinking patterns of the illiterate investor. Consider whether the greatest advantage in investing lies elsewhere. Perhaps it is not intelligence that confers the most significant benefit, that it is worth questioning whether those who incur the greatest financial losses are, in fact, often among the most highly educated individuals. This may be because financial markets do not reward academic credentials. Instead, markets tend to reward investor behavior. Qualities such as patience, discipline, and emotional control are often more influential. Many investors possess degrees from prestigious universities, yet they may still react impulsively during market downturns. Conversely, individuals with minimal formal education may steadily accumulate wealth over extended periods. This perspective characterizes what may be termed the illiterate investor. This term does not refer to an individual who lacks literacy skills. Rather, it denotes someone who has adopted an alternative approach to thinking. From early childhood, we are conditioned to follow a particular path. We are instructed to adhere to a specific formula for life. Study hard, get good grades, find a stable job, work harder than everyone else. Eventually, it is implied that financial security will be achieved. For millions of people, this formula becomes the predominant blueprint for adulthood. However, an unexpected trend has emerged. People followed the formula, yet still experience a sense of entrapment. Many individuals now earn higher incomes than previous generations, yet report increased levels of stress, greater pressure, increased debt, heightened anxiety. Many individuals do not pause to question the underlying causes. Society emphasizes the process of earning income, but rarely provides education on the fundamental principles of financial management. This constitutes the first misconception, the belief that income alone generates wealth. This is not the case, that if income automatically resulted in wealth, then all high-earning professionals and celebrities would maintain their wealth indefinitely. However, this is frequently not the case. Some go bankrupt, others remain under persistent financial strain despite substantial salaries. This occurs because wealth and income are fundamentally distinct concepts. Income is often transient. Wealth, by contrast, is structural. Most individuals elevate their standard of living in direct proportion to increases in income. A bigger apartment, a newer car, more subscriptions. Additional debt is often misrepresented as success. Gradually, personal financial freedom diminishes. Not because they are lazy, not because they are stupid. Rather, modern culture persistently encourages consumerism. In nearly every environment, there are pervasive efforts to market particular lifestyles. A watch, a vacation, a car, a version of success constructed primarily for public display. But the illiterate investor begins noticing something unusual. Many people who look rich possess significant financial vulnerability. They are often one missed paycheck away from financial distress. A single economic downturn can precipitate financial collapse. An unexpected emergency may result in significant debt. This is because outward appearances are frequently financed rather than owned. Not owned. The illiterate investor recognizes the need to reconsider the following question: how can I look successful? And instead begins to ask, how can I achieve financial resilience? This shift in perspective is transformative. This is because genuine wealth is frequently inconspicuous. Initially, it may appear unremarkable. Quiet investments, controlled spending, patience, ownership. There is no external recognition. No widespread attention is garnered. There is no compulsion to impress others. While many pursue social status, the illiterate investor discreetly develops financial systems. This is due to an understanding that eludes many individuals. A person earning $50,000 while investing consistently may ultimately accumulate greater wealth than an individual earning $300,000 who engages in impulsive spending. The distinction does not lie in intelligence. Rather, it is a matter of behavior. Many individuals assume that wealth is generated through singular, dramatic events. Point one lucky investment. One big opportunity. One overnight success story. However, the illiterate investor conceptualizes wealth differently. He perceives it as the result of accumulated structure, that IT is the product of small, disciplined decisions repeated consistently over many years, that a person who controls emotions, controls spending, avoids unnecessary debt, studies ownership, and thinks long-term already begins to distinguish themselves from the majority. This is because the financial system frequently benefits from impulsive consumer behavior. The more rapidly individuals consume, the greater the benefit to the system. However, patience is challenging to monetize. Similarly, discipline is not easily commodified. Consequently, restraint is rarely promoted in advertising. Few individuals achieve wealth by encouraging others to reduce consumption. As a result, the illiterate investor poses a unique challenge to the prevailing financial system. He adopts a more deliberate approach, that he exercises thoughtful consideration prior to making expenditures, that he conducts research before making investment decisions, that he ceases to conflate price with value. Gradually, his relationship with money undergoes transformation. Ultimately, he comes to the realization that money functions as more than a tool for survival. It also serves as a mechanism for control. This includes control over time, decision-making, and the management of stress. And the people who never learn this often devote their lives to the pursuit of higher income, without ever establishing genuine financial independence. The most pervasive misconception about money, it is not that wealth matters too much that society encourages the pursuit of income, while neglecting the systems that genuinely foster independence. Once the illiterate investor comprehends this principle, he ceases to pursue superficial appearances and instead focuses on constructing enduring financial structures. Many investors approach the stock market driven by emotion. They pursue speculative opportunities fueled by market excitement. They often follow prevailing market trends. Their investment decisions are frequently influenced by collective market behavior. They may react with panic during periods of price decline. In contrast, the illiterate investor adopts a perspective distinct from that of a typical trader. He approaches investment with the mindset of a business owner. When purchasing a stock, he envisions holding ownership in the underlying business. This perspective extends beyond merely possessing a ticker symbol. He considers whether, if the market were to close for 5 years, the company would continue to survive, maintain its growth trajectory, and generate consistent cash flow. This approach fundamentally alters the investment perspective. Short-term market volatility becomes less significant. Long-term business fundamentals assume greater importance. The illiterate investor recognizes that price fluctuations often provoke emotional responses among investors, while patient individuals focus on analyzing intrinsic value. Contemporary society often prioritizes rapid outcomes. Immediate financial gains are frequently emphasized. Swift achievements are similarly valued. Instant gratification is increasingly sought after. However, the accumulation of wealth typically does not follow this pattern. Substantial wealth generally accumulates gradually over time. Eventually, significant growth may occur rapidly. This process can be likened to the growth of a tree. For extended periods, observable progress may appear minimal. Subsequently, the foundational elements become sufficiently robust to enable substantial expansion. An informed investor recognizes the significance of compounding. This understanding extends beyond financial compounding. It also encompasses behavioral compounding. Consistent, disciplined actions performed over extended periods yield significant results. Incremental improvements in daily decision-making contribute to long-term success. Regularly avoiding errors further enhances outcomes over time. Allowing investments sufficient time to mature is essential for realizing their full potential. The transformative effects of patience are frequently underestimated. This is often due to the perception that patience lacks excitement. However, over time, patience ultimately results in a sense of autonomy and freedom. Contemporary society is characterized by pervasive information overload. Individuals across all sectors frequently express diverse opinions. Many assert expertise regarding forthcoming investment opportunities. However, access to information is now ubiquitous. In contrast, genuine wisdom remains scarce. The illiterate investor demonstrates a profound understanding of this distinction. He recognizes that an increase in information does not necessarily enhance decision-making quality. In certain instances, excessive information may generate confusion. That IT can also introduce informational noise and contribute to emotional paralysis. Consequently, he prioritizes simplification, that he focuses on foundational principles rather than speculative predictions. These principles include cash flow, debt levels, business quality, management discipline, and long-term demand. He deliberately avoids excessive engagement with financial media and entertainment. This is particularly relevant as many individuals do not engage in genuine investing. Instead, they primarily consume market-related sensationalism. The illiterate investor engages in thoughtful study, in contrast to others who respond emotionally in online forums. Over an extended period, this difference in approach yields compounding benefits. One of the most influential concepts in investing is the margin of safety. The illiterate investor recognizes that future market movements cannot be predicted with complete accuracy. Therefore, rather than attempting to achieve perfect accuracy in every decision, the illiterate investor prioritizes risk reduction, that he exercises caution when making investment decisions, that he avoids incurring excessive debt, that he prepares for market uncertainty. This approach reflects the principle that long-term survival is more important than short-term excitement. Many investors incur losses when attempting to achieve rapid wealth accumulation. The illiterate investor emphasizes maintaining a long-term presence in the market. Sustained participation in the market generates future opportunities. These opportunities can compound significantly over extended periods. Adopting this mindset fundamentally alters the investment approach. It shifts investing from speculative behavior to a process of structured decision-making. A significant number of individuals remain confined to survival mode. This condition does not result from a lack of intelligence. Rather, it is often due to insufficient structure in their lives. Stress frequently leads to short-term thinking. Short-term thinking often results in suboptimal financial decisions. Poor decisions create more stress. This cycle tends to perpetuate itself. The illiterate investor approaches breaking this cycle through alternative strategies. He does not try to look successful immediately. Instead, the initial focus is on establishing financial stability. This includes the creation of emergency savings. It also involves maintaining controlled spending habits. Long-term asset ownership is emphasized. Financial education, behavioral discipline is consistently practiced. Wealth accumulation typically does not result from a single transformative event. Instead, it is frequently the outcome of a system of small, consistently repeated decisions. The illiterate investor ultimately uncovers a significant insight. Money encompasses more than its financial dimension. It also possesses a psychological component. The objective extends beyond the mere accumulation of wealth. The aim is to develop resilience against manipulation by fear. This involves eliminating impulsive or desperate decision-making. It also requires refraining from emotional responses to every crisis. Establishing sufficient personal and financial structure is essential, so that temporary disruptions do not jeopardize long-term outcomes. Market fluctuations are an enduring aspect of financial systems. Fear remains a persistent factor in investment decisions. External noise and distractions are inevitable. However, disciplined cognitive approaches remain uncommon. Such uncommon behaviors frequently lead to exceptional outcomes. The illiterate investor may lack the specialized language of economists. He may not possess the appearance typically associated with Wall Street professionals. He may also lack formal academic or professional credentials. Nevertheless, he comprehends a principle that many individuals never acquire. Wealth depends less on innate intelligence and more on consistent behavioral patterns sustained over time. In some cases, Those who grasp this concept most effectively are individuals whom society has most significantly underestimated. If this video changed the way you think about money, subscribe for more videos about investing, psychology, financial systems, and long-term wealth thinking. Because in a noisy world, clear thinking becomes an advantage.